Greetings, everyone. Thank you for joining us. Very super exciting, fun edition of the Surf and Sales podcast, Bonfire edition. Scott and I have been talking about how do we keep giving back to the community, and we were thinking that let's do some live shows. Let's get questions from the audience and have some amazing guests. So can't be more thrilled than to have Manny. I'm not even, it's Manny Medina, but Manny from Outreach on here, and we're going to go deep on funding, fundraising, and a whole host of other topics, leadership and growing. So Manny, thanks for joining us, man, and making the time. We know you're busy, so we appreciate it.
Oh, thank you for having me. Even Lars is here. You guys are a big deal.
See, Scott, I told you we're a big deal.
We're a big deal.
We
I
are.
hear the Ron Burgundy voice right now, right?
Right.
It's a big deal.
Kind of a big deal. So I need to get that out for my wife to hear. But anyway, before we jump into everything, we want to make sure we shout out to Find Them, certainly Outreach for sponsoring, Lead 411. Who's our fourth? Perception
Gong.
Predict, which is an amazing. They're all really cool techs, and Gong as always, right? So, but let's dive in. So, Manny, I want to go straight to early stage startup, right? And I don't know if you went through this. Did you go through the friends and family stage to get started? And I know you may have started before you pivoted to what Outreach started to be, but where did you get the first piece of capital?
Well, unfortunately, I don't have a lot of friends and family with money. So I had to make friends that have money to invest in Outreach. The first few bucks came out of, a guy called Bruce Jaffe, he's actually the first $10,000 into our cap table, first. And what you will see is that our first almost $1 million came in sets of 10, 20s, and 30s, and that's because the concept of sales engagement was not baked, was not something that people just gravitated towards. And when we came to market, there was another technology called Relate IQ that was sort of doing something kind of similar. They were trying to attack more CRM than we were just trying to be sort of like an engagement layer. But, I had to answer a lot of questions of like, how are you different? They're capitalized, they're worth quite a bit amount of money, you're worth nothing, how are you going to win? And then the fortunate thing happens, like everybody has to get lucky at some point. And our getting lucky was that Relate IQ gets bought by Salesforce for, I think, like over $400 million. And Relate IQ had a very large list of angels. And as a cold caller, that was my list. So I called from, started with the A's, worked my way to the Z's, and I raised, I don't know, $250,000 out of people who invested in Relate IQ, and then another $250,000 from their friends. So that was my friends and family round in which I sort of talked to everybody. And look, the important thing is that I am not sort of like a Silicon Valley, entrepreneur sort of format, right? Like you look at me and you don't think that, I'm not a Stanford computer science grad with a, out of YC, et cetera. So I don't look the part. I didn't fit the profile. So when you are like me, and I'm an immigrant, I'm Hispanic, there's also all these things going against me. You can't like go the regular route. You have to sort of like hack the system. And you hack the system by playing to your strengths. And I play to my strengths by getting 10s and 20s out of many, many people and have them make intros to customers and VCs, et cetera.
So how does that, the reason I'm asking is, what's the pressure like between your friends and family, whatever those friends mean, that you feel and responsible for the finance? Not that you don't, not that you don't feel responsible when a VC gives you money, but it's personal, right? Like this is really personal.
I would say, so depends on the opportunity. To me, it's always personal. So it never stopped being personal. And look, I live in Seattle. Seattle is a tiny town. And we pivoted the company when we started here in Seattle. And when people pivot, there's two ways to go about it. You can, close the other company. Everybody sort of lose their money and you start again. And it's normally okay, right? Like everybody knows the risk, et cetera. We didn't. And we didn't because you can't, part of my friends, you can't shit where you eat. You know what I mean? Like I live here. So, and the people who invested in me are people who I'm going to run into in the streets. So I can't let them down. So I brought them all along into the new company. sort of recap the company so that the founders had some upside. But I brought everybody along, and I think that sort of plays out. Look, at at the end of the day, you have to live with yourself, and living with myself being being honest and getting everyone a good outcome.
Yeah. So before I jump into the next question, I'd love everybody to just go chime in on the chat real quick because we love to have it engaging. Tell us where you're dialing in from because it's kind of cool to see. Also, please put your questions in there if you've got questions for Manny because we want to make sure we get to them. So let's talk, from that stage to, I don't know, we can talk about Series A, but really that growth from A to B, like what is the VC looking for besides product market fit, a certain level of ARR? What are they looking for as they look at the executive team? And then what are the places you sort of had to learn, okay, I'm going to B series now, I got to up my game?
So when you're early stage, so my own experience, and I don't know how investors do it, but my own experience is that when you are sort of like seed and A, your investors are looking at, do you have a really large market to go after? And do you have a cohesive team? Like the team doesn't need to be particularly senior or seasoned, but they need to be able to work together well and have some kind of superpower. Our superpower was the fact that there was 4 co-founders, and it was literally like everything, every position was covered. So that we had a backend developer, a front-end developer, a designer, and myself who was selling and doing everything else. So that team took us from A to B, from C to A. When we got the A from Mayfield, what Mayfield was sort of looking for was not only, is the team cohesive, is the market big, but do you have customers who are not only like raving about your product, but are in it to help you develop it. And we had 2 really early customers around the series, like around the Series A. One was AppDynamics, who bought in really early, and the second one was Cloudera, where I met with Lars. And in Cloudera, it was a really interesting situation because they were on Yesware and they were migrating to Outreach. And when that migration, sort of like Lars became a big proponent of account-based sales development, and that whole sort of like train of thought took off, and along with it, Outreach and the tools that allow them to do that. So you need sort of like testimonials from investors, from customers who are kind of heavyweight, and they're sort of like and they have a following, and they have a thought leadership platform for you to sort of continue to draw investments. And even to this point, when I'm talking now to like investment banks, we talked about what is the road to public, and they're still the same thing. It's still make sure that you have customers who are willing to come and speak to all of us about all the great things that you got going and all the things that you're about to go build. So this is one of those surprising things that never ends. Like your customers speak for you in every single round, and in A and B is sort of like the difference between getting a run done and not getting a run done.
Manny, you just mentioned talking to investment banks, which makes me think a little bit about how little information there appears to be out there about the thought process and considerations prior to going public. Like, when do I take the company public, under what terms, and why, and that kind of stuff. Why does that feel like a black box of secrets? And maybe I'm just, not in the right, circle or whatever, but I don't see much discussion about that. So can you talk a little bit about what those discussions are like and what the considerations are there? I think it would be helpful for me to learn about, hopefully everybody else as well.
Yeah, so I don't, I'm not public and I haven't gone through it, so I can't tell you much about what it's like, but I can tell you from looking from the other side, right? Like, how do we prepare?
That's what I mean. Sorry. Yeah.
As we think about it. Yeah.
As you think about it, as you're considering possibly doing that. Yeah.
Yeah. So first of all, is there's a sort of like a work back plan to be public ready. So this is, forget about being public. There's a public ready sort of like a statement by which you run operations. And this is all about, managing the beat and raise. So you need to be able to call the number at the beginning of the quarter and beat that number at the end of the quarter, and then do it again and do it again and do it again and do that for an entire fiscal year. And then operate in that rhythm for a handful of quarters before you do anything. And if you look at even what Snowflake did, Slutman came in and along with his CFO, and they sort of like they sort of deploy that rhythm in that rigor before they even went public. And they already had a lot of growth. They already had a lot of momentum. It's about being rigorous about it. And then there's the other like little stuff, right? Like the ability to have audited, quarterly earnings and the ability to sort of like, make sure that you manage a story. One of the things that I learned from Henry at Zoom Info was that you cannot spend enough time making sure that everybody understands your story really well. And the story is pithy, and the story is impactful, and the story is something that people get behind. So if you were to break down, for instance, Snowflake stories is very straightforward, right? Is not only they're attacking a huge market, they got network effects from the fact that they have this not only the platform play, but they have the ability to connect to several customers, and they have incredible growth. So really good execution. So boom, 3 points, easy to consume, everybody wants it, right? And then the bankers help you manage sort of like that float, meaning the amount of shares that are released, the momentum that you build coming into the public markets. So you want to pre-sale. You want to sort of like get a bunch of people excited. You want to get a lot of funds with big names excited, right? So you want to figure out, it's kind of very much like fundraising, right? You want to, figure out the tier A funds and then the tier B funds. So you want to get a few tier A funds really excited and pre-bought into your IPO, and then a few tier B funds excited and pre-bought into the IPO. Then you go public and then you float very little. And that little that floats spikes because everybody wants to get in. There's no float for anybody. You got a 30x multiple, the end.
Yeah. It all sounds so simple when you phrase it like that. Just do this, that, and the other. Yeah, but that's what to me hasn't been spelled out and articulated. And maybe I, like I said, maybe I just haven't done enough research on it. But I appreciate you sharing that because it's something that I think many startup employees think about. In particular, probably employees at Outreach and companies like Snowflake, maybe a year or so ago, as they were thinking through these kind of things. I want to change gears for a second and ask you a totally different kind of question, if you're ready for it, okay? I want to know, there's so many times where businesses and founders, on their journey, get advice and counsel from people and end up making a totally different decision. So I want to know about some times or a time that you made a decision that everybody around you told you was wrong, and that you shouldn't do it, and this wasn't going to work. And then if you're comfortable sharing, like, what was the result? Did you end up being right? Did they end up being right? I'm curious about that kind of thing.
I'll tell you one that we're still, so there is, every time we have a board meeting, there is this bone of contention that, it's been 3 years and we still talk about it every board meeting. So when we brought in, so Rajiv, who came from Mayfield, had invested in Marketo before. And the Marketo playbook sort of, is one that suggests that you move on market quickly. And then you do that by, not only deploying reps and motions and having the product ready to go in enterprise, but also by continually creating a new floor for what's the minimum bite to get into the product. So we continue to have that conversation of like, how do we raise the floor and eventually get it out of the SMB space and out of the sort of like the micro account. So, and as we were going down that path, I started getting personal emails from people who were running very small companies, with 1 or 2 or maybe salespeople, or a rep that used to use Outreach in a bigger company and moved to a smaller company, and they wanted Outreach again, and we couldn't sell it to them. And I started getting all this like bad blood, unnecessarily so, of like, we not able to, go below a particular price. And I went to the board and I were like, hey, team, we're building a category here. We cannot build a category if we don't bring everyone under the tent. And I know that they sort of like, you cannot operate 2 businesses, right? If you're building for enterprise, it's much different than building for SMB, right? The SMB construct has a lot of, self-help, a lot of self-serve, a lot of, content marketing, a lot of like things that kind of like HubSpot, right? In which you start and then you don't need help and you sort of like build that your customer acquisition is really low, but you also have high churn. And then on the other hand, you have, enterprise, in which, you spend a lot of time in governance and security and policy and you invest in a professional services organization. So those are 2 different businesses. And normally companies bet one or the other. We decided to do both. And what that does is that creates sort of like, literally like a 2-hump kind of like business sort of framework in which, you know, one business looks like an SMB, the other one looks like a you know, corporate and above. And every conversation that we had with the board, you know, we would be arguing this point of like, should we be one or the other? Should we be just enterprise or just SMB? That being in both didn't make any sense. But to me, it's a principle thing, in that we can only build a category if we bring everybody along. You know, I've seen false starts from, you know, people who were in the space before me, who, you know, they either pick one or the other, and because of that they failed. And I think that we have to pick both. And, you know, we still need to play this out. Like the game is not over yet. But I stuck to my sort of this principle thinking on that. Like, it's okay to run two businesses as long as you are aware that you're doing it. You're optimizing for one, you're carrying the other, but it's the only way you're gonna build that new category from scratch.
Cool. All right, we got a couple. I've got someone who wants to ask you a question, Manny. So Alex Smith is joining us. So Alex, go for it and ask Manny your question. And it's a good one, by the way.
Hey, how's it going, Manny? It's great to meet you, man. I'm curious because I'm in a mid-market. I'm gonna be starting a mid-market AE role, SaaS AE role, and one of the things I'm doing is going to be going over a lot of investor relations reports to kind of really look at, you know, kind of really dissect the prospects that I'm going after. And I'm just curious for you, being a CEO, what are the questions that you get asked by investors that are thoughtful? If you can think of like the most thoughtful question that you get asked that really gets meaningful information from you, that I should be looking out for from other CEOs when those type of questions get asked. So if you could think of one thoughtful question that you typically get asked, and maybe the reverse. What are the biggest BS questions, or questions that really just don't really get investors meaningful information that you tend to get asked, if you're willing to offer up something?
Let me start by answering the question you didn't ask, which is, you know, how do you take a 10K and sort of get good information out of it? So
yeah.
Or you open up the file, the 10K, and search for management discussion and analysis. It's usually section 7. And if you want to not read anything, go to the bullet point list and read that. That is, in fact, the board conversation and what's top of mind for any CEO of a public company. If you want to get, you know, richer, read the entire section and stop right there and sort of write down what you learn and use that in your communication.
What's the worst question? What's the bullshit question you get, Manny? That people want to hear that fun stuff.
Yeah, the bullshit questions are things like your margins are too high, your margins are too low, you know, stuff that, you know, okay, you know, what do I do with it? Because, you know, and then what really grinds me, and, you know, I'm gonna just be vulnerable and open and honest here with y'all, is when somebody comes with a point of view, like your margins are too high, and then tells me that or your margins are too low, and they tell me that 5 companies that are doing better than me. But you know, one more click on that research, you can find the other 20 companies doing really well that had, you know, lower margins, like, you know, Twilio and Snowflake have lower margins than I do, and they're killing it. You see what I mean? So the real question that they should be asking is like, what is the margins growth profile that you want to optimize at? You know what I mean? And if you're growing 100% and you have 65% gross margin, that's a fantastic profile. Now, if you're growing 40% and you have 65 gross margin, that's an awful profile. But if you're like Zoom and you have 40% year-over-year growth, but you have 30% EBITDA margins, you are a unique company. You see what I mean? So like, you need to figure out who are you, like in what range are you going to operate based on your market, right? If there's a lot of growth in your market, you may want to sacrifice points of margin for points of growth. And that's the sort of like, those are the thoughtful conversations that good boards have of like, you know, they will ask you, like, tell me your story. Like, tell me what is your you know, long-term growth strategy, right? And the long-term growth strategy could be, you know, I'm going to sell data warehouses that are more efficient, that are lower cost, and that eventually they have this network effect because people can connect them in the back end and pay less to move data around. And then I will have an ecosystem of people moving the data around, and that's my growth strategy. That's a growth strategy. You see what I mean? As opposed to, are you growing too fast or growing too low, and what is your margin?
Where did you go to learn this? Or did you just learn it by, you know, trial and error?
By getting beaten up.
What's that?
By getting beaten up and answering this question wrong 3 times, and then reading somebody else's ones and be like, oh, I fucked that one up. I should have read that one. And then getting smarter over time.
Um, I'm going to let Lars come on. So Lars, come on. I know you got a good question in there too, and hopefully it's not too scary for Manny.
Lars,
Thanks,
we'll be
Richard.
asking you.
Good to see you, Manny. Looking forward to later this week. So I think I know the answer to the question, but how many founders did you start with? And how many of those founders are in seat today? And tell us a little bit about what you think about multi-founder startups. And the question comes from my work as an advisor within True Ventures and other venture capital firms. And the kiss of death being the 3 founder or the 4 founder, because a lot of VCs and investors shy away from multi-founder startups. Can you tell us a little bit about that?
Yeah, no, I got that a lot when I have 4 founders. So it's myself and 3 others. And I got that question a lot of, how is it going to work with 4 founders? And we divided the company equally at the very beginning. And that was a principal thing for all of us, because pre facto, when you fund the company, you don't know how things are going to turn out. And it turns out that I feel that, so I'll give you the other side of the argument, which is by having 4 co-founders who are fully vested, just as capable, and there for each other, I think we were able to grow faster than our entire competitors. As you know, Lars, when we came into the market, our market was busy. It was incredibly competitive with companies that had, 10 times more funding than we did. And out of all those companies, all of them are gone or rebranded. And I attribute 100% of that success to my co-founders. So I wouldn't be here without them. Now, to answer your question, my co-founders are no longer here. And they departed at around $75 million in AR is when they sort of started peeling off. And there were 2 sort of like critical events that made them pursue their own journey. One of them was my 2 co-founders, Gordon and Wes. They really wanted to get back to like coding. The whole, managing increasingly large teams was not their thing. And they had a bone to pick with building a collaboration tool, a collaboration platform. That had always been their dream. They started going down the path. Outreach was a great, startup for them. And, we were lucky that we were able to cash them out a little bit for them to go and do their thing. And they really wanted to go do that. And if that's their passion, that's a dream, I thought that, that they would go ahead and do that. Andrew peeled off, at around 80 some ish. And he really wanted to build something in hardware. So he went off to like go research the hardware space because that was his calling, that was his passion. Now, it helped the fact that all of them have kids around the same time. So they all became new dads, and they were like, I got to take some time off and spend time with my child. Once you spend time with your child, your mind wanders and you question your life, etc. And they, went off and do that. But what allowed us to do was to bring in, because they sort of found their own replacements as they were leaving, they brought in people who were just as committed and just as good to be my sort of like new set of co-founders for the next leg of the journey, right? Like the 100 to IPO journey. And I frankly, like, I appreciate that. Like, I know that there are some other, parting of ways that haven't been as amicable as ours, but, our co-founders are so tied to our, our outcomes that they had all the incentives to make sure that, not only that we were well placed, but that we were, but they brought in somebody who brought, continue with their ethos and continue to bring the company forward for a long term. I consider my co-founders kind of like my brothers. They're 10 years younger than me. I made sure that I look out for them, at all times, even when we were building the company as they exited, because I want to make sure that they're happy. Like, life is too short for them to not be happy in what they were doing. So, I always make sure that they are doing well. And, I think we are each other's trust, managers, I think it's called, whatever, like, they set up, I think Wes is on my daughter's trust and I am on his daughter's trust. Like, we're all tied, by blood at this point. I mean, like, we administer our daughter's, money at this point. So, like, we're beyond co-founders. We're like, family. And I feel like, that story is what made us who we are. And I don't know how else I would have done it without it.
Manny, you talked about entering a crowded space and how a lot of the competitors are no longer there. What is the best and worst part of having such a high profile rivalry? in your space. There's been multiple incendiary moments from one side towards the other, mild mudslinging, one might say. What's the best and worst part about having such strong, link to a competitor or competitors?
I think the best is that it raises the profile of the entire market. So we're all aware because everybody's sort of watching,
Yeah.
The activity creates noise. The noise is actually good for building the category. Again, it wasn't up until 2015 or 16 that, that sales engagement became a thing. Before, there was just a bunch of point solutions, and even the companies who were there did not have, I don't know if it was timing, it was the right people, et cetera, to sort of like bring this category forward. The current batch of competitors, like now we're bringing the category forward to the point that even, Microsoft and Salesforce have jumped into the category. So I think that to answer your question, the best is the fact that the noise has generated enough awareness of the category. The worst is that it's, we still need to go and finish the job, right? Like we need to build this for the customer. We need, our success is the success of our customers and their outcomes, not sort of like, the petty shit between two.
Yeah, it can become a bit of a distraction.
It does, to a point. And
Yeah.
I feel like personally, we have done a really good job of staying above that kind of conversation, but it's annoying and sometimes, and
Yeah.
you try to sort of take the bigger approach of like, competition is good. It whips up sort of like, energy around the category, and it makes people sort of like excited about it.
Yeah. You mentioned sort of like, I'm going to put words in your mouth a little bit, but like you had a couple of co-founders at the beginning, and then they moved on, and you added a couple other co-founders. It makes me think of like stage appropriate executive hiring. And that's Max and I and Richard had this conversation a long time ago, maybe a year ago now, but we were talking about stage appropriate VP of sales, VP of marketing hires. And, so-and-so is the 0 to 10 million, 0 to 20 million person. And so-and-so is the 20 to 100. And this person is the 100 to, IPO kind of thing. Are you a proponent of the stage appropriate kind of executive hiring? I mean, you've had a couple heads of sales. Was that, planned and stage appropriate, or is that just kind of the way it unfolded? I'm curious what your thoughts are there.
That's a really deep question. I don't have a perfect answer for you. I usually don't. So I don't plan for a stage appropriateness, if you would. But it is tricky, right? Like even a company that, I don't know, when do you stop being a startup? You see what I mean? So like,
yeah, I don't know either.
Even if you cross 100 million AR and you're like, talking, big game, IPO stuff, like it's still day one, so you still have to, do IC stuff. You still have to hustle just like you did when, we were 4 people. So for me as a look, I'm not a serial anything. I barely consider myself an entrepreneur. So I don't know what I don't know. I only know my own journey. And in my own journey, I think that you have to have this mindset of prepared to change for what's appropriate for the next stage. But if you don't, it's okay too. You know what I mean? Like if your thing is, 0 to 50 or 20 to 100 or like, 30 to 150, whatever your stage is, or like the number of people, right? Like your team, you're really good in a team of 10 people. The moment that your reports have the reports, that's when things break. I think having that sort of like self-awareness is very healthy. And it's very healthy because you have to know what you like, what you don't like. You know what I mean? Like if you like it all, then go for it, right? But if there is a sweet spot of operation that is really your shop, your thing, stick with it. There's this stigma a little bit associated of like, oh, we scale out of some person's ability to grow. And I think that's wrong. Because people should be happy doing, what they're good at. Like there's some people who are just not very good at the early stage. Like I don't consider myself I thought I was an awful early stage CEO. I'm a much better later stage CEO. And
why is that?
Because I don't like, I'm not a great marketer, for instance, and I feel like all the good early stage CEOs are kind of like Max. They're in for the hack, for the the burst of growth, for the ability to do very little, for the ability to make something with very little and sort of like continue to hack it. I am much better now that I have teams and I can think longer term, and I can sort of, pause and think a bit more strategically. I can make, I'm great at the 2-year bet. I'm not so great at the 2-month bet. You know what I mean? Like I can bet on something that it's going to take a year and a half to pan out, and just deliver it and ship it and like make a big deal and sort of like change the trajectory of the market. The little stuff, like, it's grinding for me. Like I'll fake it until I make it, but it was grinding, right? So when I started, I was doing sales by myself, right? And the way I would do sales is that I would go and borrow leads from whoever, right? Like I would call friends who were in sales operations, and I'll borrow leads, etc. And that was fun for a little bit, but I wasn't great at it. You know what I mean? Like somebody who would be great at it would be somebody who like really learns, SEO, and really learns like, how to sort of create a better funnel, who stays up late at night and writes content that is pithy and attractive and that kind of stuff. I never got into that. So like I never consider myself a great CEO. I'll sell the shit out of anything, and I'll build some products. And that's what I do.
Yeah, I'm going to not take people off mute just for the essence of time so we can get to more questions. But John Stern asked a really good question is, when you're young and you're trying to grow the team, how do you appropriately measure or rank the team to go, can this person get me to there, right? And
say that again.
Yeah, so when you're growing from A to B or B to C, you do have to sort of step back and look at, okay, can this sales leader get me there? Can this marketing leader get me there? How do you determine if you've got the right team in place based on the stage you're at and where you're going?
The one metric that you track at all times is pipeline coverage. The sooner you come up with a good rubric for your business on how much pipeline you need to generate to hit that number, the better off you're going to be. Your life is just going to get significantly easier. And of course, the larger the number, the better. Everybody needs more pipeline. That's not a secret. But you need to understand what is your sweet spot. Too much of it, you're wasting money. Too little of it, you're not going to make the number. And all you need is 1 quarter. And you will feel it. You will need 1 quarter in which you barely make the number. That the last deal comes in at the last moment at 10 p.m. and it was a stretch, and you have to give discounts and throw in some professional service and do some weird stuff to get that deal over the line. That's the moment your sort of like spidey sense needs to go up and be like, do I have the right people in the boat? And that's when that should be a trigger for inspection, because that means that you're not running the appropriate amount of pipeline to the number you need to hit. That's the simplest way of thinking about the problem.
Got it.
And then you have to figure out how is, depending on your business, how's your pipeline generated? Is it a mix of inbound and outbound? Is it SDR driven? Is it self-generated? Like you need to figure out like what is your shop type. But those are the 2 things that tell you whether you got a team that is humming or not.
How do you learn as you grow an organization, right? Like, and for some people, I think it's easy. For me, it's not. Scott and I talk about this all the time. How do you learn to trust the team? Like, what does Manny say to Manny of like, okay, even though I can see this accident that may happen, I'm going to have to let go of the steering wheel and let that occur?
Although you're talking to the wrong guy. That should be your next introduction.
Richard's still trying to figure out how to trust me.
That's I think it's every year is my #1 area of development. It's my potential for growth.
Right. What's been the biggest surprise as you've grown this? Like as you've gone from where you were as 4 people in the garage, for lack of a better phrase, to now, what was like, oh my God, like I had no idea this was going to be this way. And I know that I'm sure there are many of them.
So I'll tell you my area of struggle, and I'll pick up from your last question. Is the whole like letting go. Because when you build everything from scratch, you tend to believe that sometimes you sort of think too highly of yourself and you think you can do everything, right? And you drive yourself to do inspection and do everything. And those inspections at the very beginning, they're kind of fun, and there goes Manny asking all his questions, whatever. But at some point it becomes distracting, especially once you have teams of teams and you're international, and now you're in the mode of beat and raise, etc. the managing through people has been my hardest and probably most rewarding experience in the growth of Outreach and in my own professional growth. And then the managing through questions, right? Like I just finished reading Reed Hastings' latest book on the No Rules. I recommend everybody to stop right now and go read that book. And there's this.
Well, finish the podcast. Hold on, finish this, and then you can go read the book. Hold on.
All right. Don't leave yet. But there's this area of like, you either lead by telling people what to do or by giving people the context. And it's so easy as a founder to just tell people what to do. And you have to like almost like speak slower, you know what I mean? To like make sure that you catch yourself not telling people what to do and giving people the context. So this is called, general's intent. This is called many, many different ways. But you have to, or at least when I say you, it's me. I had to learn and relearn every day this art of giving people context and just giving people the broader question, not what I thought the answer was. So for instance, I used to say the moment that an account got an escalation, I immediately was like, do we have the right AE? Do we have the right CSM? And the better answer is the team a good fit for where the account is at the moment? Not just the AE or the CSM, it's the entire team, right? It's a training consultant, where they onboarded right, where they upgraded, once they pass a particular threshold. Is a system ready for that account, or did we do it wrong and we have to go and revisit that? You see what I mean? And those are materially different questions. With one, you're implying something. With the other one, you're actually letting people explain where you are in the system building and where you're going with the system building. And it's been incredibly hard for me to operate this way, but it's also been very rewarding, because I can see my own thinking getting better and elevated by asking these different kinds of questions.
As you've gone through the various rounds of funding, let's say you get several sheets, right? You get a couple of offer sheets on stuff, and you have to eventually turn one down. Does that really burn the bridge that you could never go back to them? Is that how it works?
Nope.
They're willing,
No.
if they liked it once, they'll want to come back again.
This is Manny's 5 steps to raising almost $300 million. You build a small cadre of investors that really understand your business. And you grow that cadre of investors by 1 or 2 at a time, and you bring everyone along through each round. Because even if they turn you down, they can invest in the next one, and they can invest in the next one, and they can invest in the next one. So these people will make your time to fundraise very, very short. My last 3 fundraisers took each of them 2 weeks. Why? Because each of these investors already knew us. They're already seen our movie. They already believed in the market. They believed in the TAM. They believed in our execution. And all they had to do is get the latest update and what's the price. So you will never disappoint anybody. These are multi-layer games. So the people who you pass on a particular term sheet, they will be around for the next round. There's no shortage of money in this world.
Yeah. Any mistakes you can share when you're going from A to B or B to C when you were pitching to your VCs? Like, oh, I shouldn't have said this, or I should have shared more of this, or again, there's no playbook that I know of that tells you really well how to do this.
There is the one thing that I see a lot of entrepreneurs make the mistake is that when somebody asks to explain your TAM, your total addressable market, they come up with this really complicated equation. And if your TAM is not a number times another number, then you lost the VC. So you need a headline number that talks about your addressable market in a way that is both believable and very, very simple. So yeah, there's a story about me in Business Insider on how I raised Series, I think it was B, with 3 slides. And one of them was literally the TAM. And the TAM said there is 6.5 million B2B sellers in the US, and we sell for $100 a seat per month. That's it. That's a TAM.
Do the math. Yeah.
Do the math. I'll wait.
That's awesome. That's easier than the math I'm working on with my son in distance learning. So I'm like going back to A squared, B squared, C squared shit. So I hope everybody wrote that one down.
Yeah.
Question: as you go from C to D or D to E, do you go to D to E because you need the money, or that it's so cheap to get the money, or how do you know when to stop taking funding and go, all right, we don't need any more right now, or do you just take it because you can, and then decide, okay, we're going to go down this other path, right? We're either going to sell out, we're either going to let someone buy us, or we're going to go IPO.
Yeah, that's a great question, and yeah, that's a great question. Because we would like to, again, be public ready. We look at the quality of investors that we would get in each series, and will they help us get to our ultimate destination. So for instance, on our last round, we had Sands Capital and Salesforce Ventures. And Salesforce has been a powerhouse in terms of public investment lately. They were in Twilio, they were in Snowflake, they were just making some big, bold moves. And we thought that having them would be accretive to the mission. And then having Sands Capital, which is also a public fund, will be a long-term buyer. So you sort of started setting yourself up to become a public company that has very stable set of shareholders. So people who are there for the very, very long term and are just buy only, right? Don't get those hedge funds who are long shorts, because you could be on the wrong side of the equation and you're screwed. You want to be you want to have on your cap table people who are very long-term minded, who believe in your vision, so that they take up the majority of your equity going forward.
So were you thinking that way right from the start, Manny? Like you had that kind of vision right in the beginning when there was you and 3 other people in a garage, so to speak, or did that vision kind of crystallize and evolve for you?
That was never a vision. That was more of an execution thing of like, how do you go from Silicon Valley walks out the moment you go public, and then what, right? So, and I have a goal of being I want to be a happy public CEO. I mean, I don't want to have to manage all sorts of drama with like people coming in and out and like very militant investors, etc. So what after Series D, we realized that the next round we're going to do is probably going to be either a Silicon Valley outfit or somebody who's not from Silicon Valley. It's just a big fund. And we're in a situation right now that every single public investor is making private investments too. Even countries are doing private investments. So there is so much money in the world and so much understanding of private companies that you can pretty much pick who you're gonna partner with. So now you start talking about what is your long-term prospects and thinking about the dynamic as your Silicon Valley investors wean out, who is going to be your next batch of friends who are going to be on your who you're going to be accountable to. I mean, you're picking your bosses, for all intents and purposes. You want to make sure that you are picking your boss right, because you're going to have to answer some tough questions for them in terms of like your investments, your bets, if the business doesn't perform as well, et cetera. So you have to just pick right.
I think that's something that everybody, regardless of their role and what stage they're at, should remember about picking your bosses.
I think the things I'm going to walk out of this with today is one, we got to have a simple math equation, Scott, and then we got to find the right countries with the right surf breaks to invest in.
That's right. The Costa Rican government is ready to invest.
That's right.
Do that.
So Manny, when did you realize that you hit on something here? You're building a new category. When did you have a moment where you're like, holy shit, this actually could be a unicorn? Or do you ever just sit around and kick yourself and be like, how is this real? Is this really happening right now?
That's a great question. So the is this real happened to us kind of early when we had a customer that we deployed and at that point we didn't have a lot of safeties in the application, and they did something that sort of completely decimated their Salesforce instance, and we have to repopulate it. This is before you, Lars, so I didn't experiment with you. This is before I signed up, Lars. And we were so bummed. Like, we had to work all night, and they were mad. And we work all night. This customer's in New York, so we work through the night. We wake up, and the stuff is not ready yet. And I get a call from the VP of Sales saying, "I guess I'm sending my team to lunch early." It's like 10 a.m. New York time, and like we're sort of like we're like, oh my God, we're gonna lose this customer. It's gonna be awful, and like we're not that big, right? And then we solve the problem, and then we stand back, and we're like, guys, we're important. Like if our reach is not up, people are not selling. Like we are needed. That's a very
That's a big moment. Yeah.
Right? Like there's product market fit and there's your mission critical. And those are two different things, right? Product market fit could be a good vitamin. Mission critical is like, if you're not up, we're not selling. And that's what really, so that gave us not only like the hope and the encouragement, but that gave us perspective, because the road is going to be bumpy all the way through, whatever the outcome is. And, whenever you find a tough spot, like, reminding yourself that you're here and you're needed is a very comforting thought, So, and if you're needed for a 50, 100, 200 people company, you're going to be needed for a 10,000 person company. And all the bumps and bruises that you're going to run into all the way there, they're fine. Like they're not as meaningful if you are struggling to get up there.
I want to come back to the thing you talked about, the hedge fund, because I've been hearing about this for about 12 or 18 months, and I'll assume you've been approached by some at some point. Talk more about, for people who don't know, talk more about really why, when could you or should you take the hedge fund, or like why you stay away from it. Like I got this impression from you that you were like, these are like loan sharks. They're not Salesforce Ventures. They're looking at the number. They're not going to hear your, rationale on product market fit or any of that stuff. Like talk more about that, because I don't think people talk about it, but I know it's out there.
So my point of view on this is that I found the conversations with this public funds a lot more, I found them a lot more meaningful and sort of nuance that the ones that I had with my, average, 5 years ago Silicon Valley investor. Now everybody's getting smarter, so everybody's sort of on the same page now. But when we took the round from Lone Pine, which is an offshoot of Tiger, it was beautiful in that they had a hypothesis in the market. They said, there is room for an engagement platform that actually elevates the use of CRM. And we did the math. We talked to our customers. We did all this pre-work up front, and here is a term sheet for $100 million or $1.1 billion valuation. Like it was almost magical, the amount of preparation that they did. And I think that the world is getting very smart, like really, really smart. And because they're seeing, especially this investment funds are seeing, scale ready private companies as the next frontier for them to understand, because they thrive in this sort of like, information misalignment, right? Where they know more than the next guy, hence they can make a trade. So they understand, the fact that if you pick a couple of private companies and spend a year doing research, you're all of a sudden ahead of everybody else. And if you are now in a position to make outsized returns. So everybody's looking for an angle. And if that angle happens to meet your thesis, all of a sudden you have a really big check writer. You know what I mean? Like these funds are so Lone Pine is a $20 billion fund. Just think about that. $20 billion fund. Yeah. American Capital is a $1 trillion fund. Wellington is a $1 trillion fund. The largest Silicon Valley outfit has 600 million, to a couple billion tops. So these people are trading into trillions. You see what I mean? So like, it's a disproportionate amount of like capital to deploy that the people you're talking to. Yeah. They're very long because they can't get out. Once they're in, they're in.
When you say that, the world's getting smarter, right? Does that make it harder or easier on you?
I think it makes it easier. For the winners, it makes it easier because your story now resonates. Your story has now a landing spot. Before, if I got too complicated with the model and the sort of like, how we internally at Outreach, we think of flywheels, right? By helping a customer drive an action that drives an outcome and completing that circle, our machine learns, right? So I tell that story, and at the very beginning, half the investors would be like, it's just whatever, I don't understand. And now, the people that I talk to from public funds are very sharp, very attuned. They ask, very insightful questions. So I find that it will work out better for the true entrepreneur, for the people who know what they're doing.
Question, what's the most grateful mistake you've made in building this company?
What mistake?
What mistake did you make that you're grateful happened? You're like, oh, you know what? I was wrong about that, and thank goodness I was wrong.
Oh my God, I have a catalog of those.
I know it wasn't bringing Max in, so I know that.
We made a lot of, boneheaded decisions early on in terms of like product that we thought were going to work that we end up shelving. So, we're about to release sentiment, but before we built this entire system in which you will like put the sentiment of an email in the product. And we thought that people were going to love it and like people are going to click, and nobody clicked. Nobody cared. And I mean, that wasted like, a full quarter of resources. And when you're small, that's a lot. So that was one mistake of product that we ended up building that nobody liked. I don't know what other mistakes have we made. There is a whole like, this will happen to a lot of entrepreneurs that, your VCs will tell you to go and, move to enterprise, like land a big customer, right? So you will hustle and like land somebody huge. And we did that early on with a really big telco. And it was so hard to deploy. Like it was so hard to get people to adopt. Like, and I feel like there is a mindset almost that you sell into. So like everybody has read Crossing the Chasm, right? Or heard about it at least, right? Not, yeah. So like the whole Crossing the Chasm is real. Meaning there are some people who are the innovators who will adopt your product, and and you will slowly move to early adopters. Don't go and sell to the laggards. They're just not ready for you. I mean, they may buy you, but you're going to spend all your waking hours trying to get them to do something. And it's just such a waste of time. You know what I mean? And like, of course, and like, when investors tell you, oh, all your customers are all tech companies, like, of course they are, because they're innovators. You know what I mean? Like, so we're not selling to each other. It's a real economy out there. So like, it's nothing wrong with being tech heavy, because they're sort of, you build a product on the back of them. They push your boundaries. They help you get better. And then once you have a scalable product, then you can go and sell to, AT&T and Walmart, whatever that is. But don't sell too early to those people who are on the wrong side of the adoption equation, because it will be an enormous pain in the ass. You will waste all your cycles on that, and you will do unnatural things that you'll regret you did.
So we're going to flip this a little bit. What kind of questions do you still have? You got 43 people here who could answer a question for you on anything about sales engagement. What would you like to ask them, or Scott and I?
So what's different? So headline, what is different post-COVID? And then, what is marketing like post-COVID? Like, it's not events anymore, right? We used to have Unleash, and that was big, et cetera. Like, what is a new sort of like seminal event? How did you create a category post-COVID?
Anybody want to jump in on that?
I don't want to hog the spotlight. There's got to be somebody here who's raising their hand. John Stern is raising his hand. I see John Stern raising his hand. Richard.
Can you get him? I don't.
Yeah, hold on.
There it is. John, you got to unmute. There you go.
Perfect. Thanks, Manny. Thanks for coming on. And I think post-COVID, we've seen it with the rise of these communities and selling in communities, and more social, I guess, is like the buzzword for it, but it's more personable. Like, I know I was doing it pre-COVID, but I consider myself a trendsetter. Like, my little kids were in on all my meetings. Now everybody has their family at home. And my personal life is much more on display in my business, and it's much more in whole life enveloping instead of just work life and all of that. And we're either like, living in our offices or working from home or whatever it might be. And people are searching for these human connections. And I think, Scott has his Patreon and Thursday night sales group, and there's this rise of all these micro communities. And for me personally, I have a startup, and I can get all these leads and meetings just from these communities instead of going through traditional old school sales processes and outreach and things like that. So I think post-COVID, people are really looking for that connection that they're lacking in the physical world, probably because they're not going out and seeing their friends. And there's a huge opportunity within like networks and, one-on-one video applications, and just getting to know people on a personal level more so than, the traditional business sense of like doing a cold call and following up with an email sequence. No offense to outreach or anything, but I think people are really looking for a very personal connection post-COVID.
That's great. You might
Nailed it.
follow
Well
up on
said,
that.
John. Go
What's
ahead,
that?
Manny. Yeah, follow up.
Yeah. So what are these communities and what apps are you using for one-on-one video communication?
John, hold on. John got muted again. So communities. So obviously there's Sales Hacker community, right? There's Revenue Collective. There's Rev Genius. Folks like Dave Gerhardt, Kevin Dorsey, and myself have built communities on Patreon.
Yep.
One could argue that Richard and I started community events, small scale, micro community events with Surf and Sales, for example. Thursday night sales that Amy Bolas and I have run now for 30 something weeks in a row, you know, weekly happy hour. There's probably 150 to 200 plus people every single Thursday night there asking questions like this, back and forth dialogues. And like John was talking about, deals are getting done, right? Leads are happening real time. Hiring is getting done in real time. Introductions are being made in real time. Discussions about tech and the evolution of the field is happening in real time. So those are a few of the places and communities that I'm thinking of. John, you want to add on to Manny's?
Yeah, I mean, you nailed a lot of the good ones. There's Modern Sales Pros. There's a bunch of ones that have been known for a while. There's also like this app called Chalk. There's also Clubhouse that are like those audio, communities kind of. A bunch of people are on Discord. There's so many micro communities. And then from the micro community, like Thursday Night Sales that Scott and Amy have, another micro community comes from that one. So people are really striving to kind of drill down, like you connect on LinkedIn, but then you go to another place to have that conversation or whatever, or get to know people better. So I think that people are really, the ones that I'm in are Thursday Night Sales, Scott's Patreon, and Rev Genius, and then the ones that are on that Chalk app. But there's so many now, and I think people are more accessible than ever before. Like you can get CEOs of companies through these communities or wherever they are and get their ear like you never could before.
Yeah, this is how you get executives time, for example, Manny. Like if somebody here messages me and says, hey, can I get 30 minutes to pick your brain? The answer is no, right? But now with the rise of micro communities, the answer is, yeah, actually, you know what? I have this Surf and Sales Bonfire session with Manny and Richard. I have this Thursday night sales thing where every Thursday I'm available for 2 hours. I run these Tequila Tuesday events every Tuesday on my Patreon community. So it's an easy way to get access to people. And like John was talking about, you get their whole kind of family life, a real clear picture of who they are, which helps you potentially decide, do I want to work with this person, right? What are they really like? So I think these things are quite powerful. Somebody mentioned Bravado is another, micro community around sales. I know there's marketing events like this as well. Gitano and Chris Walker run a sort of the marketing version of Thursday Night Sales, which the name of the event eludes me. But that's how I would take that question. Richard, do you have anything you want to add?
I mean, I think I will add all of that is correct, and it's super easy. Like every one of these people could have screenshotted all these names or taken a picture of the 3 pages of people, and then you go to LinkedIn and you connect with them, not to pitch them, not to sell them, but wow, there's 50 people that I could connect with and start to share more knowledge with, and then over time, our network is our net worth. As much as I hate shit like that, but that's what it is, right? Like that's really what happens, and I think that's what these micro communities have done. And they allow, Manny, it allows you in a non-outreach capacity or sales hacker capacity to talk to people you wouldn't necessarily talk to, right? Like your outreach people are people who are your customers or your prospects, whereas this is just a freaking community, and who knows where this could take you, right?
Right.
And I think that's, and then in lieu of that, you're giving so much back to the community. And I think that's what the communities are about, is like, where do we go to support each other? How do we figure this out? And I think it's forcing a lot of companies to understand the long tail in their brand.
Yeah.
That you got to really sort of build it there. That was a long answer, I think, for your question, but
No, but this is exactly what I was looking for. I have this fundamental belief that everything will be different, especially when it comes to B2B marketing, that it's going to look more like this, where it's going to be a lot more targeted, a lot more useful in the moment. You're going to be influenced by other people who are not influencers, but are people that you respect because they're in the community and they have done something that you respect, and they have your trust and the credibility. So
Yeah.
this is super helpful, actually.
Great. I think it's been helpful for all of us. I think we're all thrilled, and I hope this was different for you in terms of the kinds of questions we grilled you with.
Absolutely, it was awesome. It was fun.
Yeah.
It was
All right.
fun, and this is a good time because my CFO's on vacation and my legal department can't see me. I may have said something that I must have not said.
I'll be sure to send him that snippet. That'll be the one snippet that I put on LinkedIn for him. Oh, my CFO.
Yeah.
So, man, thank you so much. And again, thanks to Outreach and to Find Them and to Lead 411 and to Perception Predict and all of our other sponsors and Gong, of course. So thank you so much. We really appreciate it.
Absolutely.
Thank you, everybody. And thank you, Manny.
Bye, everybody.